The past couple of years have been pretty crazy for financial markets, going all the way from the predicted doom at the beginning of COVID and when everyone thought the world was going to end, all the way to the moon boy stimulus fueled rally of 2021, then back down to a massive devaluation of stocks and real estate in 2022. And throughout most of this, the consumer has fared pretty well. But there are a couple of things that are coming up right now that I think can really put the consumer in a very tight spot. Hey everyone, it's Jonathan here. And in this video, let's discuss a couple of these things that I believe will be negative catalysts to consumers over the next about 6 months to a year. Then at the end, I'll give you my take on what I think about all of this. So let's just get into it. The first thing that I think is really going to be a headwind to consumers is we all know throughout the pandemic that student loan payments have been on pause and that interest has not been occurring on student loans. Well, back in June when Congress was trying to figure out the debt ceiling and all that stuff, a part of the bill that they passed promised that the Biden administration would not extend student loan forgiveness much longer. And then in July, the Supreme Court kind of backed that up by denying Biden's student loan forgiveness plan. So pretty much because of this, no one got any of their student loans forgiven, or at least a majority of student loan holders didn't. And student loan payments will resume in October, and interest would start accruing in September. And when you think about the average student loan payment sitting somewhere about $400 a month, the average college graduate salary sitting somewhere around $60K a year or about $5K a month. And then let's say you take out 25% for taxes, retirements, etc., like those typical withdrawals you usually get from your paycheck. That leaves the average college graduate with a take-home income about $400K a month. So when you put that all together, essentially they're losing about 10% of their purchasing power. When you think about the fact that the average savings rate currently sits at about 4%, many of the student loan borrowers that have to start resuming their student loan payments in October, they're not only going to have to pretty much eradicate their savings, but they'll also have to probably dig a little bit into their budget. And generally speaking, what's the first thing that goes in anyone's budget? It's usually discretionary spending. And then when you add on the layer that people with higher incomes tend to not only go to college, but also they tend to have more discretionary spending, it's almost like putting a wet blanket on the economy as a whole. So think things like travel, restaurants, new cars, apparel. Those industries will probably suffer the most from this student loan repayment. And we're already seeing some of this being forecasted out in various companies' earnings. Just the other day, JetBlue announced their earnings. Them, as well as other airline companies, are starting to expect lower guidance for the next couple of quarters. And some of them have even gone so far to say that the resumption of student loan payments is one of the factors why they are projecting out less sales in the future. So I know that everyone doesn't have student loan payments that are coming due, but there are a couple of other things that I think will affect consumers. I think that inflation will still have its effects on consumers in the long term. The reason why I say this is that even though the most recent CPI reading we got sits at 3% year over year, which is a little bit more in line of where inflation normally is, common misconception of inflation, and it was actually funny because I was talking to an Uber driver the other day, and they actually kind of proved my point. Is that a lot of people, when they think about inflation, they think that when the price of something goes up and it stays high, even if it stays high for a while, they still think that it's still inflation. People think inflation as like the nominal value, where inflation really is the rate of change. So a good way to put this is that let's say a brand new car costs you $50,000 in 2019, and that car now costs you $100,000 in 2022. And then let's say in 2023, that same car still costs you $100,000. Well, technically speaking, between 2022 and 2023, there was no inflation. Even though the prices have gone up so quickly between 2019 and 2022, there was inflation between those two periods. But 2022 to 2023, there technically wasn't. And this is very important to know because the Federal Reserve, all they care about is slowing down inflation. So they just care about making the rate that the price of goods go up slower. They don't necessarily care about prices reverting back down. But granted, a lot of people haven't gotten pay raises to catch up to inflation. And given the fact that we're starting to head into a job market that's starting to become a little bit tighter, you're not seeing people leave jobs and get like 50% pay increases that much anymore. No, at least not as much as you saw maybe the past year or two. I think right now what's happening is that there's a lot of consumers out there that are still burning through their savings or maybe some debt that they could take out, which we'll get into a little bit more later on. Right now, that's what consumers are kind of burning. And at some point, that reserve will run out, whether it's debt or savings or anything like that. So I think that inflation will eventually catch up to consumer, and I think it'll take a while of this pay growth over time to really have consumers catch up to all the inflation we've seen over the past year or two. Something else that I think will affect consumers is rates. And it's more of the lag effects of rate hikes. Like what we're talking about with the job market, we are starting to see the job market start to cool down a bit. We just got a jobs report that is showing some slowdown in the job market. And when you think about what causes the job market to slow down, a lot of times it's usually companies' inability to be able to raise money to invest in their businesses. Because the way you got to think about it is that when a company hires you, they're basically investing in their company. They expect to get a return on you. So let's say they're paying you $100,000. They expect you to be effective where you can not only pay your own salary, but you can also make money for them as well. That's just kind of how capitalism works. But what happens is that a lot of times companies may hire you and you might not be profitable for them off the jump, but over time you do become profitable. So what they'll do is they'll take out a loan or they'll take out debt so they can hire you and pay you for the first maybe couple of years. And then once your position becomes profitable, then they can start using the profits to start paying for you. But when you're inside an environment like this where interest rates have moved up so much so quickly, you end up at a spot where a lot of companies don't have that ability to be able to borrow money and get an ROI on you. So because of that, they tend to start to eliminate positions and start to lay people off, which we have seen a lot in the tech sector. And even though we have seen this start to happen, what's somewhat worrisome is the fact that, generally speaking, usually what the Fed does has a lag effect. So the Fed right now has just recently started to really put the brakes on rate hikes. But they've been hiking rates for almost the past, I think at this point, almost 18 months, if not longer. Well, usually there's a lag effect of about a year to a year and a half of the rates that they hike, which makes sense because the whole process I just told you about the job market takes a while. And then when you look at other markets that are affected by rates like housing, it takes a while for higher rates to really entrench itself into the market. So that's what kind of causes these lag effects. Or another good lag effect, at least when we talk about the consumer, is when you think about debt. Let's say someone's spending money on a credit card to live a certain lifestyle. Well, that credit card is going to get more expensive as those rates start to push up more. You could say, oh, well, what happens if the Fed comes out and starts cutting rates soon? Well, from everything that I've been hearing from Jerome Powell, it doesn't seem like the Fed's anywhere close to even thinking about cutting rates. So I think because of these lag effects, I don't think we've necessarily seen the maximum amount of pain to the consumer, whether it's from the income side of things in the job market, or if it's from the expenses kind of things, from debt servicing, or even using debt to go buy goods and services. So I think that if the Fed does say that, hey, we're going to keep rates higher for longer, like they've been saying for the past almost year now, then I think that the consumer could really get caught in the crosshairs. This is where you have a lot of the bearish folks come out and say, oh, well, we're going to head into a recession and the Fed isn't going to cut until we're in a recession and then it'll be too late. And then the world's going to end and gold will be the only thing that survives and all that crap. Anyways, so another thing I think is going to affect consumers as well, and since we're on the topic of rates, is actually real estate. And I've kind of been hinting at this throughout the entire video, but let's go a little bit deeper into it. Real estate is one of the most interest sensitive markets. And due to a rapid rise of mortgage rates over the past year and a half, we've seen kind of these two different islands of homeowners start to form. On one side, we have all the homeowners who either bought or refinanced during the pandemic and got their 2.5-3% rates. And then on the other side, we have these homeowners that are buying now and that have 6, 7, 8% interest rates. what we're starting to see is we're starting to see a lot of homeowners who have like 2.5% rates on their mortgage, but they don't want to refinance into like a 7% mortgage. So what they're doing is that to tap into their home equity, they're taking out home equity lines of credits. And this has been something that we have seen start to surge recently. And I think that why we're seeing it surge is because people still want to live that 2021 lifestyle, but they don't understand that they live in 2023 where inflation has pushed everything up and they really can't afford to live that lifestyle. It was only because of all the stimulus and the pent up savings and all of those things why they were able to afford that lifestyle. So we are starting to see a boom in HELOCs, and at some point people will run out of money in these HELOCs. You can almost catch yourself into a really nasty situation because you could max out your HELOC and then now you have this big old burden of debt service that you have to pay. You know, some of these HELOCs now, even if you get a really good rate, maybe you're still paying like 8.5%, 9%. So now you're stuck with this high interest rate loan and you have to service it while we're in a time where a lot of companies are reconsidering some of their investments they're making. Like I said, employees are investments to companies. So now, and then you're also getting squeezed because now you have your student loans coming due. So you could really end up in a bad spot. And I think that a lot of consumers will get squeezed by this if they're not very disciplined on how they spend the equity from their homes. You know, we've seen originations of HELOCs actually move up about 34% versus 2021, according to TransUnion. So there is a big HELOC boom going on. Then I think to make matters even worse when it comes to real estate is that, so there's this common thinking in real estate that when rates go up, prices come down. And that kind of makes sense because most people who buy a home, they buy a home with a loan. If the cost of money becomes more expensive and you only qualify for a finite amount of payment, well then guess what? The price that you pay has to go down. And this is kind of why we saw the market turn down in real estate throughout 2022. But in 2023, what happened? The rates started to stabilize and that relationship started to break. And right now, like I said earlier, the Fed is kind of in this position where they're considering keeping rates higher for longer just to really make sure that they don't make the mistakes of the 70s and that they really make sure that inflation is flushed out of our economy. And there's kind of two camps of thinking of where real estate will go now. There's camp number one which is the traditional textbook thinking, which is, oh, well, when the rates come down, the prices will just go up even more. Now there's this other camp of thinking, and this is a camp that I side with a little bit more, is that when rates go down, prices will go down as well. And this is my thinking behind it, is that I think that if we see rates go down, so let's say we see rates go from, right now it's saying like 7-8%. Let's say we see rates go from 7-8% all the way down to, I don't know, let's say 4%. At 4%, someone with a 3% mortgage might look at that and be like, oh, we have $100,000 of equity in our home. And if we go buy another home, we would only be paying 4%. It says 7%. Let's go sell our home and go buy a bigger home. Or even the people who want to hang on to these low interest rate mortgages who are now currently renting their homes out. All of that demand that's been sitting on the sideline because of high interest rates may come out if rates do go down and may start to sell their homes, increasing the inventory and hence lowering prices. And then a lot of people on the other camp where it's the rates go down, the prices will just go up even more and then housing becomes more unaffordable. That camp, they believe that, oh, well, look what happened in 2021. But the problem with 2021 that you have to realize is that people didn't have student loan payments. People had stimulus coming out of their ears. They had the child tax credit. They had the stimulus check. All these other stimulus programs coming out. Also on top of that too is that if you own stocks were at all-time highs in 2021. Crypto was at 70K in 2021. 2021 was an environment where like if you're in the market, you basically couldn't lose unless if you're short in the market. Because of all of these tailwinds to consumer back then in 2021, you have to understand that in 2023, we don't have all of that anymore. Like all that stuff is gone. Like it is long gone. I don't think we're gonna have buyers who are so supercharged with cash to be able to buy these homes at these elevated prices. And if this inventory starts to hit the market, then we may actually see a dip in real estate prices. A very unpopular opinion, I know, but so in terms of real estate, that's my take on it, but I am kind of split. I think that for buyers moving forward, they may end up inside a better deal making market if we do see inventory start to move up. For sellers, I think that increase in inventory will bring prices down, but I don't think it'll bring prices down a significant amount. I also think there will be a higher presence of sellers because rates are so much more comparable to what their current mortgage is. Then for homeowners who have HELOCs, I think they're the ones who are probably going to get screwed the most, mostly just because they might get caught in that crosshairs of trying to service a really expensive loan that has a variable rate. And also another thing with HELOCs too is that those rates usually follow the Fed funds rates pretty closely. But when it comes to mortgages, they tend to follow the 10-year treasury pretty closely. Because think about it, most homeowners usually hold their mortgage for about 5 to 7 years, which is along the timeline of a 10-year treasury. Because you have to understand that mortgage-backed securities are seen almost as low risk as US treasuries, especially nowadays with all the underwriting and things like that that go on in real estate. Because of this, if the financial markets start to predict that the Fed will start to cut rates soon, what will happen with the 10-year treasury is that it'll actually front run that cut of rates and in turn cause mortgage rates to come down with it. Whereas for HELOCs, the HELOCs don't front run. The HELOCs will just go with the Fed funds rate. So you may actually have a chance where a mortgage might be more affordable than a HELOC in terms of rates. It'll probably will be an arbitrage that doesn't last very long, but there definitely will start to be an arbitrage between the two different levels of rates. So that's basically all I got for you guys today. Thank you so much for watching. As always, please like, share, and subscribe, and I'll see you in the next video. Peace.